Here's the paradox no one is talking about. The United States is choking off one of the world's largest oil reserves, warships are circling the Caribbean, sanctions are tightening, and yet oil markets are barely flinching. No spike, no panic, no crash. On paper, Venezuela should be shaking global energy prices. In reality, Wall Street is acting like nothing changed. And buried inside that disconnect is a lesson about power, capital, and how modern markets really work. A lesson every investor, business leader, and policymaker ignores at their own risk. To understand how we got here, we need to rewind to a time when Venezuela wasn't a punchline or a humanitarian headline, but an energy superpower hiding in plain sight. It's the early 2000s. Oil is king, and Venezuela is sitting on the largest proven reserves on Earth, larger than Saudi Arabia. PDVSA, the state oil company, isn't just a producer, it's the financial engine of the entire country. At its peak, Venezuela pumped over 3 million barrels per day, supplying refineries across the United States and funding massive social programs at home. For American energy companies, Venezuela was strategic. Heavy crude from the Orinoco Belt was perfectly suited for Gulf Coast refineries. Chevron, in particular, embedded itself deeply, investing billions in joint ventures that promised decades of stable returns. The vision was simple. Venezuela had the oil, the US had the capital and technology, and global demand would do the rest. But that balance depended on one fragile assumption: political stability. As Hugo Chavez consolidated power, PDVSA stopped behaving like a business and started operating like a government piggy bank. Profits were redirected, expertise drained, and maintenance deferred. Production quietly slipped. When Nicolás Maduro took over, the decay accelerated. Sanctions followed. By 2020, output had collapsed to under 400,000 barrels per day. What was once a cornerstone of global supply became an afterthought. Now fast forward to today, US-Venezuela relations hit a new low. Naval patrols expand. Sanctions enforcement hardens. Tankers are intercepted. The message is clear: Venezuelan oil is effectively locked out of global markets. On the surface, this should be a supply shock. Millions of barrels trapped underground, fewer exports, higher prices. But here's where Chapter 1 begins, and where the paradox starts. Chapter 1: The Illusion of Scarcity. Oil markets don't trade on barrels in the ground. They trade on marginal supply, the next barrel that can realistically hit the market. By the time the blockade tightened, Venezuela was already irrelevant to price setting. Less than 1% of global supply. Traders had priced its collapse years ago. The financial decision markets made was brutal but rational. That is to ignore the noise. Futures curves barely moved. Brent crude stayed range-bound. The consequence was shocking to anyone watching geopolitics instead of spreadsheets. A major geopolitical escalation with almost no immediate financial reaction. This is where we slow down. Oil pricing isn't about total reserves. It's about spare capacity and logistics. Saudi Arabia, the US, and a handful of others hold the levers. Venezuela lost that role long ago. So when the blockade came, markets shrugged, not because it didn't matter politically, but because financially, it already didn't exist. Chapter 2: The Winners Inside the Sanctions. While Venezuela was being boxed out, something quieter happened inside US boardrooms. Chevron received a limited license to maintain and eventually export Venezuelan oil under strict conditions. On paper, it looked like political compromise. In practice, it was a strategic gift. Chevron wasn't betting on Venezuela's recovery. It was buying optionality, the right, not the obligation, to benefit if conditions improved. Here's the financial decision: stay small, compliant, and patient. Chevron capped investment, minimized risk, and kept assets alive. The consequence? While competitors wrote off billions, Chevron preserved long-term claims on some of the cheapest oil on Earth. Investors noticed. Chevron's valuation premium widened versus peers, not because Venezuela was producing, but because Chevron had asymmetric upside. This is another moment to slow down. Optionality is one of the most misunderstood concepts in finance. It means limited downside with potentially massive upside. Chevron's Venezuela exposure couldn't sink the company, it was too small. But if sanctions eased or prices surged, it could quietly become a profit engine. Markets love that kind of imbalance. Chapter 3: Why prices didn't explode. If Venezuela didn't matter, why didn't something else break? Because the US itself became the shock absorber. Over the last decade, American shale transformed the energy map. From net importer to swing producer. When prices rise, rigs turn on. When prices fall, production slows. It's not perfect, but it's fast. The financial decision here wasn't made by a single company, it was systemic. Capital discipline replaced growth at all costs. Shale producers focused on free cash flow, not volume. When Venezuelan supply vanished, US producers didn't rush to flood the market. They returned cash to shareholders instead. The consequence was stability. Prices stayed high enough to generate profits, but not high enough to trigger demand destruction. This is the car paradox. Geopolitical risk increased, but financial volatility decreased. Markets weren't ignoring danger, they were managing it differently. Energy became financialized, hedged, and optimized. Warships moved, prices didn't. But every system has a breaking point. The climax arrives quietly, not with an explosion, but with a realization. Venezuela is effectively frozen out indefinitely. Its infrastructure is too damaged. Its human capital too depleted. Even if sanctions vanished tomorrow, production couldn't snap back. The point of no return wasn't the blockade. It was years of underinvestment and political control that hollowed out capacity. The resolution is stark. Venezuela remains sidelined. The US consolidates energy influence. Chevron holds a long-dated option. And global markets adapt to a world where ideology can destroy resources faster than geology ever could. For investors, the outcome is unambiguous. The market didn't misprice Venezuela, it wrote it off. And once markets do that, geopolitics alone can't bring value back. So what's the lesson? First, reserves don't matter if you can't monetize them. Oil in the ground is worthless without capital, stability, and trust. Second, markets price relevance, not headlines. By the time a crisis reaches cable news, its financial impact is often already gone. If you want to understand these dynamics better, studying how commodities are priced, not how they're reported, is essential. Futures curves, marginal cost, and optionality explain more than any political speech ever will. And here's the real question I want you to think about. If Venezuela had protected its oil industry like a business instead of a political tool, would the US still have this much leverage today? Or would the entire energy map look different?